2nd January of 2026, the first trading day of the year. If you are solely focused on the S&P 500's year-end slide, you're missing the most violent capital rotation of the decade. We are witnessing a complete inversion of the 2025 trade. Here is the signal. On the very same morning that major U.S. electronics manufacturers warned of a massive 20% price hike for 2026 due to chip shortages, a Chinese AI chip maker, Biren, debuted in Hong Kong and exploded upward by 100%. Do not read this as a coincidence. This is the divergence. While the U.S. consumer is about to get hit with an AI tax on hardware, Asian markets are manufacturing their own liquidity event, bypassing U.S. export restrictions entirely. The Hang Seng just jumped 2.7% to start the year, while the dollar is putting in its worst performance since 2017. The easy money trade is dead. The divergent value trade has just begun. Yet this is the pre-market pulse, and welcome again. Deep Dive 1. The lead story, the great decoupling. Let's look at the tape in Asia. This is not a dead cat bounce. This is a structural repricing of Chinese hard tech. The headline number is the Hang Seng jumping 2.7% to close at 26,189. But the real story is what drove it. We are seeing a rush of self-sufficiency assets coming to market. Biren Technology, a Chinese AI chip maker founded by former NVIDIA alumni, didn't just IPO, it doubled on debut, raising over $700 million. Retail tranches were oversubscribed 2,300 times. Why does this matter to your portfolio? Because for 3 years, the bearish thesis on China has been capital starvation due to U.S. export controls. The market is now telling us that domestic liquidity is sufficient to fund the next generation of semiconductor infrastructure. And it's not just IPOs. Look at Baidu. They just filed to spin off their AI chip unit, Hang Seng, on the Hong Kong exchange. This sent Baidu shares surging 7.5%. This is corporate financial engineering at its finest, unlocking trapped value by separating high-growth hardware assets from the regulatory overhang of the parent company. Investors need to understand the mechanics here. This spinoff allows Baidu to attract dedicated semiconductor investors who wouldn't touch a broad search engine conglomerate. It aligns management incentives and opens new financing avenues that don't rely on Wall Street depository receipts. The market impact here is high because it signals a reopening of the IPO window in Hong Kong, specifically for hard tech. If you're underweight Asia because you're waiting for a trade truce, you are late. The trade isn't a truce. The trade is the bifurcation. Capital is flowing into the companies building the walls, not the ones trying to tear them down. Deep Dive 2. The macro driver, the inflation paradox. Now, pivot to the US and Europe. We are walking into a macroeconomic paradox that is going to confuse the Fed and punish passive index fund holders. We have two screaming data points that shouldn't exist simultaneously. First, the deflationary signal. Oil has capped its biggest annual decline since 2020. Brent crude is looking at $55 a barrel in the near term. Supply glut, OPEC plus disarray, and record U.S. production have crushed energy costs. Normally, this is a green light for consumer discretionary spending. But here is the trap. While energy costs fall, the AI tax is arriving. A report from the Financial Times confirms that global consumer electronics prices are set to rise by nearly 20% in 2026. Dell, Xiaomi, and Lenovo are all warning of supply crunches. Why? Because the memory chips and high-bandwidth semiconductors that go into your laptop and phone are being cannibalized by data centers training AI models. Samsung and SK Hynix orders for 2026 are already exceeding capacity. This changes the equity valuation models for 2026. If you're along the consumer discretionary basket, XLY, thinking gas savings will translate to spending power, you need to hedge. That disposable income is going to be eaten by higher costs for hardware. Furthermore, this complicates the Fed's pivot. The dollar index just recorded its sharpest annual drop since 2017, falling 8% last year. The market is pricing in rate cuts. But if electronics, a core component of the CPI basket, spiked 20%, the Fed may not be able to cut as aggressively as the bond market hopes. This creates a dangerous setup. A weak dollar increasing import costs, combined with a supply-side shock in tech. You want to be careful with unhedged U.S. importer exposure here. The soft landing narrative ignores this specific supply chain bottleneck. The silent mover, the EV margin squeeze. While the headlines scream about AI chips, the silent mover shifting capital allocation is happening in the global auto sector. The narrative of exponential EV growth is dead. The new narrative is brutal consolidation. We just got the December numbers. BYD closed the year with 4.6 million vehicles sold, up nearly 8%. But look closer at the mix. Their pure battery electric vehicles, BEVs, are accelerating, but their plug-in hybrids are softening. Compare that to Zeekr, Geely's premium brand. They just broke the 30,000 monthly delivery barrier for the first time. What drove it? The Zeekr 9X, their first hybrid SUV. Visual CUE. Photo of the Zeekr 9X SUV with price tag $66,620. Host. Here is the thesis connection. The silent move is the market rewarding companies that can pivot their manufacturing mix instantly. Zeekr is winning because it pushed upmarket into the $66,000 luxury hybrid space, creating margin protection. Meanwhile, Li Auto is seeing deliveries down 24% year-over-year as they struggle with product realignment. The market is noticing this efficiency before the headlines do. We are seeing a divergence between volume chasers and margin protectors. With the dollar dropping, U.S. dollar-denominated exports from these Chinese giants become even more competitive globally, further pressuring Western legacy auto. If you're holding global auto exposure, you need to ask, does this company have the balance sheet to survive a price war where the competitor just increased volumes by 50% while your currency is devaluing? For many, the answer is no. Lightning round. Wow, seems like we have some rare guests here today. Let's translate this into immediate action. 3 tickers, 3 verdicts. First up, NextEra Energy. In context, the utility giant just launched a massive $4 billion at-the-market equity program to fund investments. Verdict, bearish short-term. While the long-term AI power thesis is intact, a $4 billion dilution is a heavy blanket on the stock price. You stay away until the equity indigestion clears. Next, Vanguard Infotech ETF, VGT/underlying exposure. Dell, context, electronics makers warning of 20% price hikes due to memory chip shortages. Verdict, neutral with a put hedge. The demand is there, but the margin compression from surging component costs is real. Bullish only if they can pass 100% of that 20% cost on to the consumer, which is a gamble. Finally, Comcast, CMC say, context, spinning off the cable networks into Versant to trade separately on January 5th. Verdict, bullish on the parent, CMC say. They're shedding the low-growth deadweight. The remaining Comcast entity is a play on broadband and premium streaming, cleaner and higher margin. Let the spinoff drift by the parent. Tomorrow's playbook. So, what is the playbook for tomorrow's session? We are watching the dollar index, DXY. If it breaks lower, the rotation into Asian equities accelerates. The smart money is front-running the Fed cuts by buying growth in markets that have already corrected, specifically Hong Kong and high-end Chinese manufacturing. The risk to this thesis is the chipflation narrative. If bond yields spike because the market realizes inflation isn't dead, it just moved from oil to electronics, growth stocks will get hammered. Positioning takeaway. Don't chase the US beta rally. The value is in the divergence. Look at the makers of the hardware, the chip foundries and miners, rather than the sellers of the boxes, Dell, Lenovo. And keep an eye on that Brent crude level. If it snaps $55, we are looking at a deflationary bust that changes everything. Trade what you see, not what you hope for. I'll see you on the open, and this is the pre-market pulse. We scrape the noise, you trade the signal. Thank you.